Have you ever looked at the stock market and thought, this can't keep going, right? You're not alone. Jeremy Grantham, the legendary investor who saw the dot-com and housing bubbles before anyone else, says your gut feeling might be spot on. According to him, we're living in one of the most overvalued, overhyped markets in history, and the crash isn't a matter of if, but when. In fact, he called it the cataclysmic decline. Sounds terrifying? It should. But there might be an opportunity for you. In this video, I'll break down exactly why Jeremy Grantham is sounding the alarm, what makes this market bubble so dangerous, and, most importantly, how you can protect your investments. I'll guide you through what's coming next and how to turn potential chaos into opportunity. Let's talk about Jeremy Grantham for a second. If you're not familiar with his name, you're going to want to pay attention. Grantham is one of the most respected investors of our time. Why? Because he's been right when it mattered the most. He predicted the dot-com bubble in 2000 and the housing market collapse in 2008. That's two of the biggest financial disasters in modern history, and Grantham called them both with startling precision. Grantham is the co-founder of GMO, a firm that manages billions of dollars and specializes in long-term investment strategies. But here's what sets him apart. He doesn't just look at the short-term noise in the markets. He studies the big picture, decades of data, historical trends, and underlying economic forces. In other words, he's not the guy chasing the hottest stock of the week. He's the guy looking 10, 20, or even 50 years into the future. What makes his current warning so significant is his track record. Grantham has been saying for years that the US stock market is in a bubble, but now he's doubling down. He believes this bubble is unlike anything we've seen before. Bigger, riskier, and fueled by factors that most people aren't even paying attention to. So, whether you're an investor, a saver, or just someone trying to make sense of this crazy financial world, understanding what Grantham is saying could be the difference between riding out the storm or getting caught in it. Alright, so here's the big question. What exactly is Jeremy Grantham warning us about? In his words, the US stock market is sitting on one of the biggest bubbles in history, and it's only a matter of time before it bursts. But this isn't just a minor correction he's talking about. Grantham is predicting what he calls a cataclysmic decline, a crash so severe it could ripple across the global economy. So, what's his reasoning? First, let's talk about bubbles. Grantham defines a bubble as a market event where valuations reach levels that are completely detached from reality. To figure this out, he uses a fancy metric called a 2 sigma event. Without getting too technical, it basically means that prices are 2 standard deviations away from their historical norm. In plain terms, this just means prices are way off from what's considered normal, so rare it should only happen once every 44 years. But here's the catch. These once-in-a-lifetime bubbles are happening way more often, like in 2000 with the dot-com crash and in 2008 with the housing market collapse. And now, Grantham says we're in another bubble, one of the biggest yet. Grantham believes the current market is a perfect storm of overvaluation and hype. Stock valuations are sky high, fueled by relatively low interest rates, speculative investing, and, you guessed it, AI mania. He even compares this moment to the dot-com bubble, where internet stocks soared to ridiculous levels before crashing. The only difference? According to Grantham, this bubble is even bigger and more dangerous. What's worse is that timing a bubble is notoriously difficult. Grantham himself admits he doesn't know when exactly this one will pop. It could be months or even another year before we see the fallout. But the problem is that the longer the bubble inflates, the harder the crash. Think of it as stretching a rubber band. It might hold for a while, but when it snaps hard. Still not convinced? Grantham points to clear warning signs, like the absurd valuations of tech stocks, the sudden influx of speculative money, and even the overvaluation of non-stock assets like housing and commodities. And if all this sounds eerily familiar, it should. These are the same warning signs we saw before the last 2 major crashes. One critical data point that underscores Jeremy Grantham's warning is the current state of the CAPE ratio, a widely respected measure of stock market valuation. As of January 2025, the CAPE ratio stands at 37.15, a level that places the market in alarmingly overvalued territory. To put this into context, the CAPE ratio peaked at 44.2 during the dot-com bubble in 2000, marking one of the most speculative and overhyped periods in market history. That crash wiped out nearly 50% of market value. Similarly, in 2008, just before the housing market collapsed, the CAPE ratio reached 27.0, coinciding with the global financial crisis that devastated economies worldwide. Today's CAPE ratio is dangerously close to the dot-com bubble peak and far above the historical average of 16, signaling a level of overvaluation that cannot be ignored. This trend is clearly visualized in the historical CAPE ratio chart, which shows how extreme market valuations have consistently preceded major market downturns. Grantham refers to this as a 2 sigma event, a rare statistical anomaly where valuations deviate significantly from their historical norms. These events have historically triggered severe corrections, and the current CAPE ratio suggests we're on the cusp of another. The chart also highlights how these valuation spikes have coincided with past crises, including the Great Depression, the dot-com bubble, and the 2008 financial crisis. Now, to be fair, Grantham doesn't think the market will crash tomorrow. In fact, he acknowledges that speculative bubbles can last longer than anyone expects. For example, he pointed out that the dot-com bubble peaked long after people started calling it overvalued. But the fact remains, bubbles always burst. It's not a matter of if, it's a matter of when. And when this one does, Grantham predicts it could wipe out 50% or more of the market's value. So what's causing the bubble that Jeremy Grantham is so worried about? It's not just one thing, it's a combination of forces, all working together to inflate the market into dangerous territory. Let's break it down. First up, technological hype. Grantham points out that we're living through another tech-driven mania, much like the dot-com bubble of the late 90s. This time, it's all about artificial intelligence. AI is being hailed as a game changer, something that will revolutionize industries, boost productivity, and create untold wealth. And honestly, there's truth to that. But here's the problem. Investors are piling into AI-related stocks with a level of enthusiasm that's completely detached from reality. Remember the dot-com bubble? Back then, companies were being valued on nothing more than a vague promise of future profits. Sound familiar? Grantham warns that AI could follow the same pattern, with the hype driving valuations to unsustainable levels before reality sets in. Next, let's talk about overvalued markets. Grantham has analyzed almost every asset class, stocks, bonds, housing, and even commodities, and found extreme overvaluation across the board. Take the US stock market, for example. Valuation metrics like the CAPE ratio and price-to-earnings ratios are far above their historical averages. But it's not just the US. Grantham also highlights overvaluation in emerging markets like India, where stock prices have surged to levels that defy logic. In his words, these markets are priced for perfection, meaning there's no room for error. One bad earnings report, one unexpected geopolitical shock, and the whole house of cards could collapse. If you zoom out and study the big picture, you'll see that bubbles follow a predictable life cycle. First, there's a period of excitement where investors flood the market with money, driving prices up. Then, there's euphoria, where valuations reach unsustainable levels. Finally, reality sets in, and the bubble bursts, leaving a trail of financial destruction. Grantham points to the dot-com bubble and the housing crisis as textbook examples of this pattern, and warns that today's market is following the same script. And then, there's the demographic problem. This is a long-term issue that doesn't grab headlines like tech stocks or housing prices, but it's just as important. In developed countries like Japan, South Korea, and even China, fertility rates are plummeting. Fewer people mean slower population growth, which eventually leads to slower economic growth. Think of it like this. If the workforce isn't growing, productivity and innovation can only do so much to keep the economy moving forward. Grantham believes this demographic shift will be a significant drag on global markets in the years to come. When you put all of this together, AI mania, overvalued markets, and demographic decline, it's easy to see why Grantham is so concerned. These aren't isolated issues. They're interconnected drivers that are pushing the market to its breaking point. And the scary part? Each of these factors has the potential to amplify the others. For example, when tech hype starts to fade, overvalued markets could collapse faster than expected, and a slowing economy could make the recovery even harder. It's a chain reaction waiting to happen. If there's one thing Jeremy Grantham is certain about, it's that the next few decades will be defined by volatility. We're entering what he calls an era of more frequent and severe economic shocks. Think of it as the new normal. But here's the thing, volatility doesn't have to mean disaster. With the right strategies, you can navigate this storm and come out stronger. So, how do you prepare? Grantham's advice is clear. Focus on resilience. That means investing in companies with strong fundamentals, low debt, wide profit margins, and sustainable business models. These are the businesses that can withstand shocks and adapt to changing conditions. So let's cut to the chase. What does this mean for you as an investor? How do you protect your hard-earned money when the storm hits? Grantham doesn't just predict disasters, he also offers strategies to navigate them. Let's break it down. First things first, diversification is your best friend. Grantham suggests that in times of extreme market overvaluation, it's critical to spread your investments across asset classes. Think beyond U.S. equities. Consider international markets, commodities, and even defensive sectors like healthcare and utilities. These areas tend to hold up better during downturns. The key is to avoid putting all your eggs in one basket, especially in sectors like tech that Grantham believes are dangerously overvalued. Next, focus on quality over hype. It emphasizes the importance of investing in companies with strong fundamentals. Think low debt, solid cash flow, and wide profit margins. These are the businesses that can weather the storm when the market turns volatile. Sure, it's tempting to chase the latest hot stock, but Grantham warns that speculative plays are the first to collapse in a downturn. Now, let's talk about opportunities in green tech. Grantham is a big believer in the potential of renewable energy, sustainable materials, and innovative agriculture. These are where he sees massive growth potential. For example, companies working on alternatives to lithium and cobalt like sodium-based batteries are poised to benefit as the world transitions to more sustainable technologies. Grantham calls these bonanza opportunities that could pay off big in the long term. Finally, here's the most important takeaway. Don't panic. Prepare. Grantham isn't suggesting you sell everything and hide your money under the mattress. Instead, he's urging investors to be proactive. Take a hard look at your portfolio. Are you overexposed to risky assets? Are you prepared for a market downturn? The time to act is now, not after the crash hits. Want to know how to analyze any business using Buffett's criteria in minutes in this current market and see if it's a good fit for your portfolio? Click the video on screen to find out.